So we have Proton. It's on WhatsApp. The question is on WhatsApp, Emily. Proton Limited. So the current capital structure, the current capital structure, the current capital structure, the current capital structure, Proton Limited. The current capital structure, what they have told us is that currently they have debt. Debt worth how much? Currently they have debt. Debentures are the same as debt. So currently they have debt of shillings 250 million. 250 million, 250 million, 250 million, and it's a 12% debenture, 12% debt, 12% debt. And then number two, they have, ladies and gentlemen, they have equity shares. So they have shillings 10 par value, ordinary shares, which gives us shillings 150 million. Shillings 150 million. Now, two things. When I see this kind of a capital structure, I'll be interested in the interest. I would want to know the interest amount payable. So come here, out of that, we're interested. We want to know the interest per annum. The interest per annum. Interest per annum, this is 12% debt. So what is 12% of shillings 250? 12% of shillings 250 gives us how much, ladies and gentlemen? 12%. 12% of shillings 250 inakuja ngapi? 30. So inakuja interest, old interest is 30 million. How about when I see equity shares, shillings 10 per value, I'll be interested in the nose. So please come and give me the nose. Nose is number of ordinary shares. Number of ordinary shares, what do you think shall we do? For us to be able to get number of ordinary shares, very easy. You take the share capital given, you divide by the par value. You take the share capital given, you divide by the par value. Could you kindly help me do that? The share capital given, divided by the par value. What do we have here, somebody? What do we have here, somebody? 15 million. So number of ordinary shares, take the share capital divided by the par value. So we have here 15 million. Remember, this is the current capital structure, also known as the old capital structure. Very important for us to know that. Now, ladies and gentlemen, listen. What do they want to do at the moment? What they want to do, they want to raise new capital. They want to raise how much? They want to raise 50 million. They want to raise 50 million. Look at option number one. They have three options. Option number one. Option number one, we are told option number one is to issue an 11% debenture stock. So option number one, issue 11% debt. Debenture is the same as debt. So I will be looking at the interest. In this particular case, I will be looking at the interest. So could you kindly give me the interest here? Kindly give me the interest. Kindly give me the interest. 11% if they raise the entire 50 million through debt, it will be 11% of 50 million. 11% of 50 million. The additional interest, the new interest will be 5.5. Thank you very much. The additional interest here, the additional interest will be 5. So moving forward, these people will be paying how much in terms of total interest, old interest plus new interest. Old interest plus new interest. Ladies and gentlemen, moving forward, the total interest for the farm, will be 30 plus 5.5, which gives us 35.5 million. 35.5 million. Now, listen. Once I've been able to ascertain the total interest, the next thing that I'll be required to do is to remember the formula of EPS. The formula of EPS. So could you kindly, ladies and gentlemen, try to write down that formula. Try to write down that formula of EPS. Try to write down the EPS formula. Try to write down the EPS formula. Is there a student who is able to remember this EPS formula? EPS, they're trying, but not yet there. Nobody has been able to scratch it well. Nobody has gotten it right. Part of a number of ordinary shares, Peter Kinyumu, that is not the formula we use. That's not the formula we use. That is not the formula we use for EBIT minus interest over ordinary share. I like that, okay. I like that. Okay, great. Thank you very much. Now, ladies and gentlemen, listen. In terms of indifference points, for us to be able to get our EPS after we normally take EBIT. You are right. EBIT, we subtract interest. After subtracting interest, we must deduct taxation. After that, before we start sharing these out to ordinary shareholders, we must come and subtract preference dividends. We must subtract preference what here? Dividends. The board is not clear. Are you able to see my board really? There's some two students I've seen who are complaining. So chances are, it is their net. Oh, another pen. Okay. Great. So we have here EBIT minus who? Interest. EBIT minus interest. EBIT minus interest. EBIT minus interest. Go ahead and less taxation. And then outside, you put preference dividends. Remember, preference dividends are never allowed for purpose of what here? Taxation. They are never allowed for taxation purposes. So then come and divide this by number of what here? Ordinary shares. Divided by number of ordinary shares. Divided by number of ordinary shares. Now, please do me a favor. Come and plug in the figures that we have in this formula. The figures that we have in this formula, I would want us to plug them in and call this EPS 1. Call this EPS option 1. So EPS option 1 itakuwaje sasa? EPS option 1, ladies and gentlemen, will be equal to, EPS option 1 will be equal to, we have EBIT minus interest ndio ushanipatia tayari under option 1. If we borrow, if it's borrowing under option 1, umeniambia interest is 35.5 multiplied by 1 minus tax. Have they given us the rate of taxation? Have they given us the rate of taxation? Have they given us the rate of taxation in this question? This question that you are doing is on your WhatsApp, 30%. So then 1 minus 30%, I don't have to repeat these. 1 minus 30% will give me 0.7. 0.7 will give me 0.7. Now, great students of mine, if we go for option number 1, do you think we shall be paying any preference dividends? Option number 1, are you seeing any preference shares being involved anywhere? Option number 1, no. So preference shares, preference dividends is 0. Preference dividends is 0. No preference dividends. How about number of ordinary shares if we go the option 1 way? If we go the option 1 way, what do you think will be the number of ordinary shares? Option number 1 way. Remember, if it's option number 1, we shall get stuck with the old number of shares, the ones we calculated up there. So our number of ordinary shares will not change. If it's option 1, remember option 1, basically, we are going to take debt for the entire 50 million. So if it's option number 1, the number of ordinary shares, you're right, they'll remain at 15. I don't want to deal with millions. They remain at 15 like that. Meaning that EPS for option 1 will be 0.7 EBIT minus, could you kindly multiply this for me? What is 0.7 multiplied by this? What is 35.5 times 0.7? Please give me this figure. Please give me this figure. Please give me this figure. 35.5 times 0.7 gives me what figure? Somewhat 24.85. So here we have 24.85. Everything to be divided by 15. Everything to be divided by 15. Thank you. Now, ladies and gentlemen, listen. Look at what is going to happen in option number 2. Option number two, remember, still, we are looking at raising shillings 50 million. We want to raise shillings 50 million. But now this time round, which criteria do they want us to use to raise this money? Which criteria do they want us to use to raise the money? We are told on that question that is on WhatsApp, we are told option number 2 is to issue a 13% cumulative preference shares. Preference shares. So we have here at 13%. At 13%. So the most interesting thing here will be the preference dividends. The preference dividends. Preference dividends, it will be 13% of 50 million. 13% of the par value. Thank you very much. 13% of the par value, that will give me what? 13% of 50 million. Remember, we are raising how much? We are raising 50 million. But now this time round, they don't want us to use debt. They don't want us to use ordinary shares. They want us to use preference shares. So 13% of 50, I'm being told it's 6.5 million. Great. Now, ladies and gentlemen, could you kindly be nice to me, like you have always been? Tell me, if we go for this option number 2, what do you think will be the total interest which will be paid every year? If we go by option number 2, what do you think will be the total interest to be paid every year? Total interest to be paid every year. Total interest to be paid every year. Total interest to be paid every year. I can see so many students saying 30, 30, 30, and then I saw some 256.5. 256.5. Remember, if we are going to pay, ladies and gentlemen, interest, it will only be interest arising out of our old debt of 250 at 12%. Remember this time round, option number 2, we are not going to borrow. We're not going to use debt instrument. Option number 2, it's dividends. It's preference shares. So therefore, we'll only be left with one loan, the old loan that we had, the old loan that we had. The old loan that we had, ladies and gentlemen, was an old loan. So there is no new loan here. The old loan was 250 million times 12%, which will give me 30 million. Thank you, and thank you very much for raising that with us correctly. Now listen, how about number of ordinary shares? Number of ordinary shares. If we go by option number 2, raising money using option number 2, what do you think will be the number of ordinary shares? Kidogo, wacha nirudi nyuma kidogo. Nimeona mwanafunzi ana make argument, anasema kwamba interest should be 36.5. Please remember, this 6.5 is not interest. This is called preference what? Dividend. It's something very different. If you mix it up with your interest, it means that you will be allowing it for purposes of tax, which will be very wrong. Remember, preference dividends are never allowed for tax purposes. We only pay interest on what? On debt. And if we go as per option number 2 and raise this 50 million using preference share capital, then the only interest we shall continue paying is our old interest on the debt of 250 million at 12%. So interest is only 30. And number of ordinary shares, of course, we know that our ordinary share capital is 150 and the par value is 10. Then, ladies and gentlemen, these will leave me with 15 shares like that. And if that is agreeable, then could you kindly go ahead and give me the EPS2 formula? Go ahead and give me the EPS2 formula. Go ahead and give me the EPS2 formula. Go ahead and give me the EPS2 formula. What do we have there? EPS2 formula. I can see Winnie. I can see Winnie. EPS2, I want you to substitute figures inside now. Thank you very much for writing the formula correctly, but I would want you to write now the proper figures inside that formula. Inside that formula, what do we have there? Inside the formula, yes. Emma amepata correct kabisa. Wacha tuone. Amepata correct kweli? Wacha tuone kama the final one it end up kwa namna hiyo. Now listen, ladies and gentlemen, my EPS2 will be equal to EBIT. I know EBIT inabakingi hivyo. EBIT minus interest of 30. Multiply this by 0.what here? 0.7. Multiply this by 0.7 because of the 1 minus tax thing. 1 minus T. That gives me 0.7. Minus my preference dividend. Preference dividend, which is 6.5. Minus preference dividend, which is 6.5. Remember, preference dividends, it has to be outside the taxation bracket. Because preference dividends are basically appropriations out of the profit after tax. It comes after the tax, profit after tax. All of a number of ordinary shares that you guys gave me as 15. So please go ahead and try simplifying these out. Please go ahead and try simplifying these for us. Go ahead and try simplifying this for us. So what will we be having here? So this and this gives me 0.7 EBIT. 0.7 EBIT minus 30 times 0.7. 30 times 0.7. This gives me 20 what here? 21. Minus 6.5. Minus 6.5 all over 15. And I think there is a student who got this thing right. But we need to give a present. So at the end of the day, that student had 0.7 EBIT minus 27.5. James amesema no present. Alikosea. Umekataa, no present. So inakuwa 0.7 EBIT minus 27.5 all over 15, like that. All over 15. Nimeandika mahali board ionekane vizuri. All over 15. All over 15. Asante sana. Now, so this present now should go to this particular student who will be the first student to write for us EPS3 formula. If you write for us EPS3 formula, then you should be able to get our present. So we are told option number 3 is to issue additional ordinary shares of shillings 10 par value. Option 3. Option number 3. So option number 3, we are told issue additional ordinary shares of shillings 10 par value. Please talk to me. What they're telling me is that for option number 3, what they're telling me is this, that for option number 3, what they're telling me is that for option number 3, this is EPS2. What they're telling me is that for option number 3, they want us to raise how much? 50 million, but this time around by issuance of ordinary shares. Issuance of ordinary shares whose par value, issuance of ordinary shares whose par value is 10. So then I would want to know the new number of ordinary shares. So new number of ordinary shares, you take the capital raised. The capital raised is 50. I don't want to deal with millions. So 50, you divide this by 10, which gives me 5. But I know the mistake that most students do is to come and forget straight away that we had other shares, old shares. We had other shares earlier on. So you need to come here and give us now the total number of ordinary shares. Remember, the old number of shares were 15. So you need to come and take here 15 plus 5, which gives me what here, somebody? Which gives me 20. Which gives me 20. Now, ladies and gentlemen, now I need us to be very clear on this. I want us to be very clear on this. If we issue ordinary shares, this time around, for sure, under option 3, preference dividends, if it's option 3 which will prevail, preference dividend will be 0. Interest, I'm not seeing any increase in interest. So interest will only work with our old interest. Our old interest, if you remember very well, was 30. Old interest was 30, right? And the tax is 30% still. So please come and substitute in the equation. Give us EPS 3. So EPS 3 will be equal to EBIT minus interest, which is 30, multiply this by 0.7 because of our tax being 30%. So 1 minus 30% is 0.7. Preference dividend, nothing like that. So 0. Come and divide this by number of ordinary shares, which I saw some people saying 15. Forgetting that this time around, we raised this money using ordinary shares. So in this case here, the ordinary shares are supposed to be what here, 20. And of course, as I saw there, some students came and told me that my EPS 3 is supposed to be 0.7 EBIT minus 21 all over 20. That is brilliant. That is brilliant. But now I know where most students will go wrong. I know where most students will go wrong. Where most students will go wrong, ladies and gentlemen, is in Roman 2, or rather Roman 1, where they want us to calculate earnings before interest and tax and the EPS per share at the point of confusion, at the point of indifference, at the point where you are indecisive, you can't decide. At that point where people will call you a watermelon, because inside is some different color, outside, you're not able to really say that I'm aligned with this team. I'm confused. Why? Because the earnings, the EPSs on the two sides are exactly equal. So I don't know whether I go for this side or I go for this side. So I'm torn in between at the middle. So they want us to calculate the EBIT and the EPS at the point of indifference between the following options. A, option 1 and 3. Option 1, already they have the answers, these students. Already they have the answers, and they want me to explain so much, and already they got the answers. Choosy. So point of indifference between options 1 and 3. Point of indifference between option 1 and option. So what I'll do is to come and say that at indifference, EPS 1 equals EPS 3. At indifference, EPS 1 equals EPS 3. At indifference, EPS 1 equals EPS 3. The earnings, I mean, that's why I'm confused. I don't know whether to follow the Ruto side or Uhuru or the handshake side. People are confused because you don't know what will happen. You sit at the middle. So the earnings of the two sides are equal. So fortunately, we have our EPS equations. So like EPS 1, I can see it here. It is 0.7 EBIT minus 24.85 all over 15 should be equal to EPS 3. EPS 3 is here. EPS 3 is here, which is 0.7 EBIT minus 21 all over 20 like that. So our work basically will be to make EBIT the subject of the formula. Make EBIT the subject of the formula. Try making EBIT the subject of the formula. So what shall we do? We shall come and cross multiply. So please cross multiply for us. This will be 20 into 0.7 EBIT minus 24.85 equals 15, 0.7 EBIT minus 21, like that. So you have got two ways here. You could decide to divide both sides by 2020. Or you open brackets, whichever is easier for you. I simply want you to give me the value of EBIT. I simply want you to give me the value of EBIT. Whichever is easier for you. I can see Moses Mwangi giving me a figure of 52 million or just 52. Just struggle it out, struggle with it out. Tell us whether you are able to get EBIT of 52. EBIT of 52. Tell us whether you are able to get EBIT of 52. Malim has also gotten 52 million. 52 million. 52. Winnie. Thank you very much. So everybody is getting EBIT of 52. But now remember that they also asked you to give them EPS. They also asked you to give them EPS. So to get EPS, just pick any of the two EPS equations. Any of the EPS equations and substitute. So to get EPS at the point of indifference, I'll work with this one here. So it is 0.7 times 52 minus 24.85 all over 15. I can decide to work with any of the two EPS equations where I'm able to see Boniface giving me 0.77 per share. 52 Sarah for the other one, for EBIT. How about EPS? At the point of indifference, EPS. At the point of watermelon, EPS equals 0.77. EPS equals 0.77. 0.77, like that. So, and if that is okay, at your own time, I would want you to look at option 2 and option 3. Option 2 and option 3. Phoebe wants me to repeat, I don't know exactly, or she wants me to, I don't know, Phoebe, perhaps Phoebe wants us to, the 0.77. 0.77, you say, you take any of the two EPS equations, any, and then you take any of the two EPS equations, and then of course, you know, EBIT is 52. You know, EBIT is 52. EBIT is 52. So once you put here 0.7 times 52 minus 24.85 divided by 15, you will get that 0.77. Please remember, thank you very much. So how to get EBIT? Ali wants us to show him or her how we got this EBIT figure. We simply came and multiplied. Can somebody help me very fast here? What is this 20 times 0.7? Somebody give me these figures. 14 EBIT minus, how about this? 20 times 24.85. Is there somebody who has these figures? 497, thank you very much. 497 equals, how about 15 times 0.7? 15 times 0.7. 15 times 0.7. 10.5 EBIT. 10.5 EBIT minus 21 times 15. Minus 21 times 15, 315, like that. So from there, put like terms together. So this is 14 minus 10.5. That gives us 3.5 EBIT. Equals, this minus 497 goes to the other side. So it will be minus 315 plus 497. Right? So somebody has already given me a figure of 182. So it will be 3.5 EBIT equals 182. Meaning that EBIT will be 182 divided by 3.5, which gives us what figure? Thank you very much. So everybody is okay with that. So the other one is your assignment. The other one is your assignment. Now, I know the question that my friend is talking about, the one that has got reserves. Let me just project it here. It is May 2019, question number 1B, where they wanted us to give them earnings before interest and tax at the point of indifference in the company's earnings for each financing option. For each financing option. Okay. Then the corporation, or rather earnings per share at the point of indifference. So I want to give you only 1 minute. You try this question. 1 minute only. You try the question very fast. Okay. So the question is right with us here. Right with us here. So you can see the ones who got 1.68 here. They got 11 something here. Great. So what are we told here? We are told in May 2019 that Zikunze Manufacturing Limited is considering to raise an extra shillings 10 million in order to finance an expansion program. The company's current capital structure is given as follows. So we have the ordinary share capital, shillings 20 per value. There I'm able to get the number of ordinary shares. I have reserves there. Reserves there, they are nothing for me in terms of my EPS formula. 14% debentures, those are very important. 10% preference share capital, very, very important. So what I'll do, ladies and gentlemen, first of all, is to come and ascertain the current scenario. In the current scenario, I have great things here. In the current scenario, in the current scene, the current scenario, I'll come and give them the current number of ordinary shares. The current number of ordinary shares, what do I need to do? What I need to do is to come here. What I need to do is to come here and take the share capital. I divide this with the par value. So share capital is 50,000, divided this with a par value of 20. So 50,000 divided by 20 gives us what figure? Somebody give us figures here very fast. Give us figures very fast. 50,000 divided by 20, that gives us 2,500. Thank you very much. How about the current interest? I have two things here to tackle with you, the current interest and the current preference dividends. So the current interest, what do we have here? Current interest. Doreen Kemunto gives me that the current interest, 14% debenture capital. So 14% of 20,000, which Doreen has been able to pick very fast as 2,800. And then we have 10% preference share capital. So 10% of the preference share capital, which happens to be 10,000, that will give me 1,000 more. With that, ladies and gentlemen, now I should be able to fight whichever war. So like now they are telling me option 1 is to raise all the funds needed using ordinary shares at par. At par. So remember up there they told us that they wanted us to raise shillings 10 million extra, shillings 10 million. So listen here. So option 1. So option 1 is to raise the 10 million using ordinary shares whose par value is 10. Is it 10 or 20? The par value. Whose par value is 20. So come and raise this at 20. And therefore, ladies and gentlemen, what I'll be interested in here is the number of what here, somebody? Number of shares. So number of shares here will be 10 divided by 20. Number of shares will be 10 divided by 20, 10 million divided by 20, which will end up giving me what figure? This is 10 million divided by 20. So that will end up giving me what figure? Oh, yeah. That will end up giving me what figure? 0.5 million. 0.5 million here. So we have here 0.5 million. And therefore, our total number of ordinary shares, will be 2.5 plus 0.5, which will end up giving us how many shares? 3 million. Number of ordinary shares takuwa ngapi sasa woye? Number of ordinary shares takuwa ni 3,000. Remember, these figures, please remember, don't get confused here. This was 50,000 in terms of shillings thousands. In terms of shillings thousands, remember, this was 50. This is supposed to be 50 million divided by 20. Then that will give us 2.5 million if you don't want to get confused. And therefore, the total number of shares there will be the 2.5 million plus this 0.5 million, which will end up giving us 3 million. So my figures are in millions. So remember, in option number 1, we are not going to issue new debt. So interest will remain the old interest, and the same case will happen to the preference dividends. We're going to have the same figures. So, ladies and gentlemen, what I need to do is to come and remember my formula. Remember our formula of EPS. We know how it looks like. So EPS, in this case here, EPS 1 will be EBIT minus interest. We have agreed that we work with the old interest. So if you're working with the old interest, we have to agree. How do you want us to capture these figures? In millions, or we capture them the way they are? Do we capture them or to avoid confusion, let's know that this is supposed to be 2.8 million and this is supposed to be 1 million. Although if I'm the one, I would have just captured all of them in millions. So EBIT minus our old interest of 2.8 million times the rate of tax. Have they given us the rate of taxation here? Times 1 minus the rate of taxation. So taxation, the rate of tax, 30%, yes, I can see it's 30%. The rate of tax here is 30. So 1 minus 30%, that gives me 0.7 minus preference dividends, which is 1 million. Divide this by number of ordinary shares that you guys gave me down here, which were 3 million. So please go ahead and simplify for us. So EPS 1 will be 0.7 EBIT. 0.7 EBIT. What is 2.8 million times 0.7? 2.8 million. 2.8 million. They're telling me to check on my interest. I don't know whether it's wrong. Is my interest wrong or it's okay? So they're saying that interest is supposed to be 1.96. How do they get that 1.96? I would really want to know. How do they get 1.96 for interest? How do they get 1.96 for interest? Somebody help us out here. I would want to know how they got 1.96 for interest. For option number 1. Because I can only see as working with the old interest. And the old interest is 14% debenture at 20 million. 20 million. 20 million, I would want to know how they got the 1.96. Or the final answer, Oh, I know what they're talking about. Thank you very much. 1.96. So 1.96 million, thank you very much, minus 1 million. All over 3 million. It's supposed to be minus. Thank you very much. So if that is the case, ladies and gentlemen, please go ahead and put like terms together. Go ahead and put like terms together. When you put like terms together, what are you going to get at the end of the day? So when you put like terms together, this is what we shall be getting at the end of the day. Ladies and gentlemen, when you put like terms together, when you put like terms together here, you will end up having my EPS 1 as 0.7 EBIT minus 2.96 million all over 3 million. So you leave that thing the way it is, and then you go to option number 2. You go to option number 2. Under option number 2, if I could just brush through this very fast, under option 2, what have they told us under option 2? Option 2, ladies and gentlemen, is quite interesting. Option 2, they are telling us to do something very simple. So for option 2, to raise a half of the funds through the issue of new ordinary shares at par and the balance through issue of a new 12% debenture at par. Great. So what are they telling us? That we have at option 2, we have 10 million here to raise, a half. This half goes to the ordinary shares. So we raise the half through the order. So half means 5 million. 5 million. So 5 million, and then they have given us the par value. Par is 10. Par is 10. So then in this 5 million share capital to be raised, I'll be interested in getting number of ordinary shares. So number of ordinary shares here will be 5 million divided by 10. Please don't forget our old shares. Don't forget our old shares. Our old shares ilikuwa ngapi, somebody? Our old shares. Oh, it's 10. 10, sorry. It's 20, I mean. Par value is 20, sorry. Par value is 20. I don't know why this 10 par value is coming to my mind always. So it's 5 million divided by 20. Divided by 20 plus the old shares. Please don't pick the number of shares we had in option 1. These options are mutually exclusive. So I'm through with option 1. Anytime I'm making reference to any new info or other old information, I'll make reference to the very old information that we had up there. So the total number of ordinary shares will be this 5 million plus the 2.5 million. So could you kindly give me the total number of ordinary shares that we have now? Total number of ordinary shares that we have right now zinakuja ngapi? 2.75 million. Thank you. Now from there, we are also told that there is a debt component. Debt is a half of this. So it's 5 million. 5 million times what percentage? I want interest. 5 million times 12%. So 5 million times 12%, this will be my interest. This will be my interest. Interest, I'm told here by Doreen, is 0.6 million. So 0.6 million, I want total interest. Please add the old interest to this. Because there is nowhere they have told that the old interest will be surrendered. No, we shall be adding on to our old loan. So the old interest, ladies and gentlemen, here was 2.8 million. So plus 2.8 million. So in this case here, there is a good student giving me 3.4 million as the total interest. 3.4 million as the total interest. Total interest. Somebody is giving me 3.4 million. So preference dividends, that will remain. We shall use the old one. We shall use the old one. Thank you very much. Now, ladies and gentlemen, what I want you to do for me is a small favor. I want you to come and write the EPS2 equation. You write the EPS2. Please don't forget our EPS equation. Our EPS is EBIT. EBIT minus interest. EBIT minus interest into 1 minus tax minus preference dividend all over number of ordinary shares. So write for us EPS2, which will be EBIT is not known at the beginning, minus interest. Interest ushanipatia total. Please always remember to work with total interest. Total interest, which is 2.75. Total interest is 2.75 million times 0.7 minus preference dividend. Unfortunately, I've forgotten mine. What was the total preference dividend? Not 3.4, 1 million. 1 million. The total preference dividend is 1 million, yeah, divided by number of ordinary shares ambazo ni ngapi? Number of ordinary shares ni ngapi? Number of ordinary shares. Interest, I'm told, is 3. Yes. Interest, I'm being told here, is 3.4. Number of ordinary shares in your 2.75 million. Number of ordinary shares in your 3.5 million, 2.75 million. So could you kindly work hard now? Work hard and equate the two. Work hard, equate the two, give me the final answers. I'm so sure somebody must have struggled with it to the point where they got EPS of 1.68. 1.68.